We just lost our mood light. Oh, here it comes. Okay. Good evening. I'm Leslie Donovan, and I'm the president of your Northwestern Association, Alumni Association, and it's my great pleasure to welcome you here this evening to our latest Northwestern Explorers program, From Recession to Recovery, the Economy Then and Now. We have a few guests in the audience I'd like to introduce before we get to the main event and ask them to stand and give a wave. Bill Osborne, chairman of our Board of Trustees for Northwestern. Bill is the retired chairman and chief executive officer of the Northern Trust, and among his many leadership roles, he has served as a director of the Chicago Fed. Bill? Charles Katzenmeyer, president-elect of the Northwestern Alumni Association. Oh good, Charles isn't here. I've really enjoyed being president, and I'm not really anxious to step down when my term ends. So I'm going to take this opportunity to let you all know that come September I may still be here. Charles is probably running late. He works over at the Adler Planetarium. Nabil Foster, president of the Northwestern Club of Chicago. And if you haven't joined the Chicago Club, you don't want to miss more events like this, go to the website alumni.northwestern.edu and join as soon as you get home. We're also fortunate to have Sarah Pearson, Vice President of Development and Alumni Relations for Northwestern University, with us. There she is, Sarah. And Kathy Stembridge, the Executive Director of the Northwestern Alumni Association. Our very special guest, Dr. Charles Evans, the President and CEO of the Federal Reserve Bank of Chicago, has graciously invited us to his house tonight. The Chicago Fed is one of 12 regional reserve banks across the country. These 12 banks, along with the Board of Governors in Washington, D.C., make up our nation's central bank. Dr. Evans' background prepared him well for this job. Before becoming president, he was director of research at the Chicago Fed, overseeing the study of monetary policy, financial markets, regional economic issues, and banking. And much of his personal research focused on measuring the effects of monetary policy on U.S. economic activity, inflation, and financial market prices. Dr. Evans earned his doctorate from Carnegie Mellon University in Pittsburgh, and in many ways, his career has served as preparation for his current responsibility, helping formulate national monetary policy that is in the best interest of the American people. We're very happy to have him here today, and please join me in giving him a big Wildcat welcome.
Leslie, thank you very much for that great introduction, and welcome to the Chicago Fed. I really thought I was the only person who could fill this room, but obviously with an event like this and the speakers that you have, this is a great turnout. And I'm pleased to welcome the Northwestern Alumni Association to their first event at the Chicago Fed. Looking at a crowd like this on an evening after work, I just can't resist this, asking the question. It's rhetorical, don't answer. Did you ever skip class while you were in college? And if so, did you think that you would have to make it up sometime years later by coming here after hours? It's really remarkable. Now, as many of you know, the Chicago Fed and Northwestern have a long history together, and indeed throughout the Federal Reserve System there are Northwestern alumni in our bank, faculty and consultants who we collaborate with, and they share their expertise with the Federal Reserve. So it's a great tradition. I'm sure it will continue for quite some time, and it recognizes that some of the brightest and best talent is fostered at Northwestern. So welcome again. And I'd like to give a special welcome to Bill Osborne again, one of our great directors from Northern Trust. Bill retired, left our board a few years ago, and we've missed him ever since. And welcome to Marty Eichenbaum and Jan Eberly, who have also been academic advisors to my predecessor and myself before key FOMC meetings. We get a number of faculty together, and they have come and shared their insights as they'll share today. And then special thanks to Marty, who was my advisor in graduate school and helped me tremendously with my dissertation. It would not have been as good as it was without that. I only have a few minutes. And I know that Marty and Jan are going to talk about a lot of topics that I don't want to steal any of their thunder. And so as I was looking at some notes, it occurred to me that I thought I would just give you sort of, my top, not necessarily my top 5 thoughts, but I was thinking top 5. And given that I don't have that much time, I was thinking of that ESPN show with Michael Wilbon and Tony Kornheiser. Pardon the interruption, so I might not talk very long about any of these topics. But, the first one that I think is on a lot of people's mind, the thought is, the recession is over, but it sure doesn't feel like it. I think that, officially the National Bureau of Economic Research will, date the recession as over, but with the unemployment rate at 10%, and it's going to be very slow to come down, and the consumer is not going to help us that much as an engine of growth as they have in the past. This is not going to feel like a bona fide recovery for quite some time. We're going to be challenged by that for a couple of years. Second thought is that inflation, the inflation risks are unbelievably different at the moment than other things that we have faced in the past. I would say that the risks are two-sided in the sense that inflation could go up, or it could go down, and it could go up a lot, or it could go down a lot. These are... They're two-sided. I better spend another minute on that then. So at the moment, inflation has gone from, at a core level, it went from 2.5% last year, and it's under 1.5% now. It normally doesn't move that much. So that's a big, big move, and a lot of that, I think, is due to the tremendous resource slack that we're seeing in the economy. Firms can't pass along materials cost increases, and those aren't increasing like they did before. So I think there's a lot of pressure for inflation to come down. On the other hand, we have inserted so much monetary policy accommodation, our balance sheet has exploded, and so the monetary base is very large, and if you thought that inflation was a monetary phenomenon, I do think that, but the question is at what time horizon, then that's a risk for inflation. At the moment, I think those are going to balance each other out so that we're going to be okay, and inflation's going to stay in the 1.5% range and go up to the, say, 2% level that I associate with price stability. But there are a lot of risks there. Third, what's the path back to normality in the sense that the funds right now is 0, and we know eventually it has to be higher. How are we going to get there? Well, I think first off, we're going to be looking for the economy to become, a really sustainable recovery. That growth is going to be picking up, and it gets to a robust level. That's what it's going to take to bring the unemployment rate down and the labor market back to some amount of vibrancy. And at about that time, I think inflationary pressures would begin to bubble up a little bit, and that would be the time to sort of readjust monetary policy. Normality would be a funds rate of about 4%. That's probably years from now, but we're going to watch that quite carefully. Well, if pardon the interruption guys were doing their job, they'd be telling me I'm almost out of time, and so the last two things I'm only going to sort of point out as questions, and they're going to be mostly rhetorical. The fourth point would be, how confident should we be that the next financial crisis can be avoided or mitigated? We just have gone through, still going through the results of a tremendous financial crisis, huge destruction of wealth that's adversely affected everybody in the U.S. How can we make sure that we don't repeat this type of situation again? It's hard. And Bill Osborne spoke just last night to the Economic Club of Chicago, and he focused on the fact that, debt is very high right now, and debt doesn't go away very quickly. And liquidity is very important, and making sure that financial institutions have liquidity at a time when they need it is an important mitigant against a financial crisis later on. So, these are important issues which, I certainly hope that Congress wrestles with in a very productive fashion and takes action that will help us along the way. Fifth, finally, which is completely different. I remember Chairman Greenspan one time in this very room being asked the question, it was back in 2000, will there always be 12 Federal Reserve banks? And at that time, he said, absolutely. I can't imagine the Federal Reserve Act being changed in that regard. Today is an extraordinary time period where Congress is looking at everything. I'm pretty sure that the Federal Reserve will survive intact, continue to have independence as a monetary policy maker, but it sort of is an indicator of how far we've come during this time frame, that something that you could not imagine is truly on the table. So with that, I want to thank you again for coming, and I'm going to hand it off again.
It is my pleasure to introduce our faculty this evening, but first, before I do that, how many Northwestern alumni in this room are employees of the Chicago Fed? Hands up, please. My goodness. Clearly, this bank is in really great hands. Thank you so much for coming. We're delighted you could join us this evening. And now on to our faculty. Professor Janice Eberly is the John L. and Helen Kellogg Professor of Finance, and she is former chair of the Finance Department at Northwestern's Kellogg School of Management. Jan studies firms' capital budgeting decisions and household consumption and portfolio choice. She further examines the interaction of these spending and investment choices with the macroeconomy. Her current research emphasizes household finance and the cost of updating wealth portfolios, while other work focuses on the difficulties and implications of reallocating capital across sectors. Jan is an associate of the National Bureau of Economic Research and has been a visiting scholar at several Federal Reserve banks and the Federal Reserve Board of Governors. She has served on the staff of the President's Council of Economic Advisors and is an elected member of the Executive Committee of the American Economic Association. Jan earned her PhD in economics from MIT. Professor Martin Eichenbaum is the Ethel and John Lindgren Professor of Economics at Northwestern and also the co-director of the Center for International Economics and Development, which is also at Northwestern. Marty's research focuses on business cycles and international economics. His most recent work has been on the effects of changes in monetary and fiscal policy on aggregate economic fluctuations. Marty is a consultant for the Federal Reserve Banks of Atlanta and Chicago, as well as a research associate of the National Bureau of Economic Research. He has also served as a consultant for the IMF and the World Bank. Marty earned his PhD in economics from the University of Minnesota, and the Alumni Association is eternally grateful to Marty for helping us secure this wonderful venue for tonight's program. Ladies and gentlemen, please welcome Professors Jan Eberly and Marty Eichenbaum.
Now, what I have to do, first of all, is figure out how to activate my PowerPoint slide.
Select escape on the keyboard.
Oh. Except this is Jan, so just... Jesus Christ, I hear you. Got it, okay. All right, thank you. You just say it's really wonderful to be here. My most important qualification to speak to Northwestern alumni is that my daughter is a Northwestern alumni, and she tells me that there are spies in the audience, just as there were in my intermediate macro class. So if I don't do well, she will know, and my wife will know, and that won't end well. All right. Let me give you an outline of my talk, which is basically where are we now, where are we going, and I'd like to stress some important sources of vulnerability in the economy. So where are we now? In brief, we're at the tail end of what economists now refer to as the Great Recession. The good news is the crisis appears to be over. I want to emphasize that. The crisis appears to be over. For example, right now we see this indicator, house prices show signs of stabilizing. So let me explain what's on this graph. This is a graph of one index of home prices. It's the Case-Shiller Index. And you can see it starts in 1987, and you can see things start to go wild around 1997. Now, you might say, what is that dotted line? Well, that's the average real increase in housing prices before 1997, and that was about 1.6, 1.7% a year in inflation-adjusted terms. That's what typically you earn on housing across all markets. Obviously, Manhattan is different than North Dakota, but that's an average. What you see with that dotted line is where would housing prices be today if we had escaped this, I won't call it a bubble, but this big hump-shaped object. We'd be pretty much where we are now. That is to say, the good news is, it's painful news, most of the correction on average has occurred. We're about where we would have been had we not gone through this episode. So that's one indication that housing prices are sort of back, roughly speaking, where they were. Now, of course, everybody wants to know how things are going in their summer home or in their hometown, and so this breaks the Case-Shiller House Price Index by city, and you can see Chicago, the decline to December 2009 is roughly 25%. And if you're brave enough to check Zillow, you'll see that that probably applies to your house as well. So that's what the decline's been in the Chicago area. Where are we relative to the national normal? There's a lot of heterogeneity. If you were in Texas and Dallas, you did much better. It's only declined by about 4%. Of course, if you own a condo in Las Vegas, I feel very sorry for you. What about commercial property? Well, a lot of you folks, no doubt, are very concerned about that. Well, commercial property values have fallen by more than 40% since the beginning of 2007. You can break that up into commercial rents, which declined by about 40% for office space and 33% for retail space. The point, though, is, why do I say the crisis is over? If you look carefully at this graph, what you'll see is prices in those markets appear to have stabilized as far as we can tell. So in that sense, the price correction is over in commercial property values. That's one good news. However, it's important to note that delinquency rates are continuing to rise, although the rate of deterioration is slowing. So for example, what's plotted in this graph starting in Q1 2000, loans that are 30 to 89 days past due, loans that are 90 days or more past due, and in the dark blue, loans that are non-accrual status. So you can see this big, we're still increasing the delinquency rates, so that's sort of bad news. It's important to note that about half of the $1.4 trillion in commercial real estate loans that will mature between 2011 and 2014 are underwater. So, I'm sorry, I'm not always that cheerful, but there you go. Who's at risk here? The largest commercial real estate losses are projected for 2011 and beyond. The losses at the banks alone could range, roughly $200 billion to $300 billion. But they're unevenly distributed by banks. So what you see in this particular overhead, I know it's hard to follow this quickly, this comes from the Congressional Oversight Panel that was released in early February, and it's breaking down, you see, for example, Bank of America, total assets $2.3 trillion. Their commercial real estate exposure relative to their risk-based capital is 49%. So a lot of the big banks are exposed, but much less so than the small and medium-sized banks. Basically, what a lot of those folks are, their business in an important way is commercial real estate, so they're particularly exposed. So if you asset weight what would happen if these losses, if the small and medium-sized banks go under, that will have important distributional consequences, but to a rough approximation, the banking system as a whole is not nearly as affected as some of the headlines that you'll see if you focus on the small and medium-sized banks. What's another sign that the crisis is over? Well, what I've done here is just display various bond spreads. So if you look at the green, well, that's AAA bonds. And you can see traditionally, that's the difference between AAA bonds and T-bill rates, is pretty low. And what happened during the crisis is they went nuts, right? There was a flight to safety, Treasury bonds, yields collapsed, and people were afraid to hold these things for a variety of reasons, and there was this big spike. That spike was even more exaggerated for BBB bonds, and of course was nuts for high yield bonds. So one sign that things are kind of getting back to normal is that these bond yields are going back to their pre-crisis levels. So you can take some comfort in all of that. Stock market volatility has declined dramatically. So this is the one depiction of volatility in the S&P 500, and what you typically see in crises is just volatility goes up a lot as market participants are internalizing new information on a daily basis. This huge spike far to the right, you can see, is what volatility was at the peak of this crisis. The only time it's come close to that kind of volatility is the Great Depression, right? And it is actually, roughly speaking, as volatile as it was during the Great Depression. So volatility is an interesting indicator. You can actually tell a story for each and one of these spikes, and they all kind of make sense. But it is certainly very good news that the volatility is coming down to where we were. What about the stock market itself? Well, what I'm plotting over here are crashes in the inflation-adjusted S&P 500. So the purple line, the catastrophe, and that's only, I shouldn't have done that given its Northwestern talk. That's January 29 to May 1932. And what you can see with the red line, that's above the purple line, that's what happened now. So that's the, I normalize the peak of the market at 100. You can see that the market at the worst case in this recession was down by roughly 50%, and we've now recovered about 20% of that. So we're down 30% relative to peak. That's hardly good news, but relative to the other possibilities of what might have happened, you might think that that's reasonably good news. What about stocks? Well, it's an interesting indicator of stocks. Very often, if you look at price-earnings ratios, this is the price of a typical stock relative to a moving average of earnings. Over history, that rate, the average in this particular construction is about 16. And what you can see here is when price-earnings ratios really get out of whack, something bad's going to happen. You don't want to pay attention to the little twiddles, but if you look at 1929, price-earnings ratios were about 32. Remember, that's relative to this overall average of 16. If you look at December 99, it was 44. Okay, so that's before the bubble burst, so to speak, that other bubble. It was elevated before we went into this crisis, but now price-earnings ratios are roughly 20. So you don't want to micromanage this and say 16, 7. No one's saying you should trade on these things, but when things are too good to be true, they are too good to be true. And that's what we observed. History has a memory. So I think most of us take some comfort that stocks don't appear to be totally out of whack right now. Now, here's the bad news that many of you know anecdotally. The U.S. economy, this has been a great recession. The U.S. economy has lost 8.3 million jobs since December of 2007. What you can see on the left hand, what's being plotted here, this is months from the beginning of the recession. That's on the x-axis. On the vertical axis is the ratio of non-farm payrolls to non-farm payrolls at the start of the recession. So what you can see is that the current recession is enormous relative to virtually all of the other recessions in the post-war, with the possible, well, the Volcker recession, the 1980 recession, was very sharp but ended very quickly, relatively speaking. Okay? So this is a very prolonged, steep recession. To put this in human terms, very often you'll hear the unemployment rate. It's very confusing, so it's important to think about what official unemployment is. You got to be looking for a job to be counted as unemployed. If you've given up, you're not unemployed. If you're just sitting at home watching the Springer Show, we don't count you. So official unemployment went from 7 million people to 14 million people. But if I start throwing in discouraged workers, that is, say people who've left the labor force, and people who are working part-time for economic reasons, they want a full-time job, but they can only get a part-time job, then we go from 12 million to currently 24 million people are unemployed in that sense. If you translate that to percentages, the current unemployment rate, we went from the official unemployment rate 4.7% to roughly 9.8%. These things change. But the broader unemployment rate, to give you a more accurate measure of where we are, that went from 8.4% unemployment to 16.5% unemployment. Again, to put this in context, during the Great Depression, the official unemployment rate went to 25%. So that's why we're calling this a Great Recession, not a Great Depression. However, the unemployment rate is starting to decline. So what we have over here is a depiction of initial claims for unemployment, which is something that Fed officials and other people are trying to forecast the economy look at. How many people are filing for unemployment? And what you want to see here is two things. The blue line is those initial unemployment claims. When that, you notice that that tends to lag the red line, which is the official unemployment rate. So notice that the initial claims for unemployment rate, that blue line is coming down pretty quickly. It's still a big number, but it's coming down. Well, that tells you, other things equal, that we expect to see unemployment coming down, the unemployment rate. How quickly is a matter that I'll come back to in a little bit. Okay? So that's good news that those initial unemployment claims are beginning to come down. But, last quarter of 2009, if you read the newspapers, it said great news. The economy grew at an annualized rate of 5.9% unemployment. That's the revised figure. There's two things here, and Charlie alluded to this. Where did that growth come from? It didn't come from consumption. It basically came because inventories were falling less quickly. It's actually not even the case that inventories were being built up again. It's just that they were falling less quickly. So that 5.9% number is not a number that most Fed officials or private forecasters, economists, think is an enormously supportive sign. The other thing I want to caution you about, and I always do this with undergraduates, and I even do this with CEOs sometimes, don't confuse levels and growth rates, right? If your house gets blown down, God forbid, in a tornado, when you put up that first plank, the unemployment, the growth rate of your house is a really big number, but you still don't have a house. So what's this picture over here? Well, this picture is trend real GDP. That's the smooth line. That's what GDP would be growing if it grew at its average that it's been doing for roughly 250 years. The blue line is where actual real GDP is. Notice that there's an 8% gap between the two. That is to say, we've lost roughly 8% of $13 trillion of stuff that we could have had, but that we don't have, that we're not making. Right? So don't confuse growth rate and levels. This is one indication of the severity of the recession that we've now undergone. So where are we headed? Well, again, Charlie alluded to this, and in a brief word, we're headed for a sluggish recovery. Now, it's interesting, there's the typical post-war recession, if you ask what happens in a typical post-war recession, well, if you get a really big recession, you get a really fast recovery. That's a so-called V-shaped recovery that you may have read about. So if you think about the Volcker recession, I don't know if most of you are too young. You look too young to remember that. That's pandering to the audience. You get this great deep recession, and then you get this wonderful recovery. So you might ask, well, gee, if this was a typical recession like that and things were so bad now, maybe we should expect an explosive recovery, right? Because if you look at this, if you look right now, the severity of the recession, this is different measures of the severity, that's that solid blue line, you might expect a 10% recovery of GDP to grow at roughly 10%. And actually there are some serious people who were forecasting that and still are. So people like Mike Musa, who's a former IMF chief economist, he says this recession is like all other recessions that we will have. Now, with every passing day, it's one part of the V is getting sawed off a little bit. But, Mike was very, very bullish. Now, the question is, if you look at the consensus forecast, what's this? So you just look at an average of professional forecasters. So what I've got here on these green bars is what actually happened to growth of GDP, and you notice it's really low and negative. The yellow bars are what they're forecasting looking out. And what you can see is it's a pretty anemic, those numbers are pretty anemic. The annualized growth rates are roughly speaking 2%. Notice they're much below the purple line, which is the average growth rate coming out of previous recessions. So forecasters like Charlie alluded to and like I agree with think this recession is different. We're not going to get the fast V. So the question is, what's different this time? Now, if you spend a lot of time studying international economics, you spend a lot of time studying financial crises. So what I've got on this graph here is, on the left side of it, is these are all financial crises recessions. So, for example, Korea 97, Finland 91, Thailand 97. These are all episodes in which countries had severe crises induced by financial market problems. What you want to notice is two things. The worse the crisis on average, the longer it took to recover. So the typical U.S. recession lasts for roughly a year. The typical recovery after financial crisis lasts for 1.9 years. The more severe the financial crisis, the longer it takes to recover. So financial crises are different. Financial crises is, the analogy is like the plumbing gets broken. You can't just start pouring water through the system. It's leaking all over the place. It's going to take time to fix. So that's why most of us think this recession is different than the typical recession in the United States in the post-war era. And it's important to note that the financial sector continues to be a source of vulnerability in the economy. So what do I have here? I've got U.S. loan charge-off rates. So the blue line, for example, are residential real estate. This is the rate at which firms are writing off loans. We've got consumer loans in green. Commercial real estate is the orange. And commercial and industrial loans are the purple. Notice that those we're projecting, and these are actually relatively easy to project because when a firm finally writes this stuff off, you've got a lot of information at that point. It still hasn't peaked. And many of us will feel much better once we're over that peak. Right? So we think it's going to peak around 2011 and then start to come down, but surprises could happen. So that's a real source of concern. But if you believe the projections, there is hope. Now, mirroring this, these are some of the latest forecasts from the IMF. What do they say? Well, they say for the world as a whole, notice two things. 2009, for the first time in which we've been recording these things, in the post-war era, world GDP fell. That hadn't happened before in the modern era. So world output fell by negative 0.8%. The IMF is now projecting for the world as a whole, in 2010, we're going to see growth of 3.9%. The problem is that's very unevenly distributed. For the US, they're saying it's about 2.5. I think they've downloaded it from 2.7 since this forecast. That's relatively anemic. On the other hand, if you go to China, 10%. So the BRICS, Brazil, Russia, China certainly, very fast growth. In the United States, relatively low growth. I'll come back to the euro area, which is a big source of vulnerability for the world economy, is coming in at 1% forecast growth. If you, by the way, look at unemployment figures here and look at a variety of things, we don't think unemployment rates will come down significantly in 2010. They're going to be around 9.5%. We could quibble for 2010. You're not going to see a significant move below 9 probably till the end of 2011 if you believe professional forecasters. Okay, inflation, as Charlie alluded to here, you see this forecast, and we were kidding around with Charlie before when he said there's a lot of uncertainty, but that mirrors what the blue chip economists, a blue chip panel of economists are saying. Usually, the mean forecast of inflation is about 2%, what these guys want it to be. But notice that there's a big spread. There's some fear of potential deflation of the economy. If we get a lot of bad news and the economy tanks, you could get deflation. On the other hand, if they don't pull the plug in time in a recovery, if they don't get rid of some of the things they've been doing on monetary accommodation in time when the economy starts to take off, you could get some of these incredible reserves that have been built up flooding into the economy and causing substantial inflation. So it's a balance of risk that they're grappling with. Now the big question is, what's the shoe that hasn't dropped? Okay, now fortunately I'm a professor, so I don't have to worry about the implications of what I say. Now, the question is, the next stage of the drama might be, that is to say, what might get us, is a sovereign debt crisis. That is to say, debt owned by sovereign countries, and I'll come back to the issue of the U.S. in a minute. That crisis would have grave implications for interest rates anywhere, everywhere, and I don't think there's much that the Fed could do about it. So let me tell you what I mean. Think about your economic history. When the euro got put together, there was a pact that required deficits to be lower than 3% of GDP. The cheating started almost immediately. The deficit to GDP numbers in Spain, 12%, Ireland, 12%. Britain, which is not in the euro, but it's fun to know about anyways, 12%. Greece, which has been most in the headlines right now, is over 13%. So that's not even close, right? And their the debt to GDP ratios in the case of Greece and Italy are well over 100%. So these are big, big numbers. The US, after World War II, our debt to GDP ratio was a bit over 100%, to put that in context. Now, there is an important potential crisis brewing in Europe. By joining the euro, the Portuguese, the Irish, the Italians, the Greeks, and the Spaniards benefited from low interest rates. Why is that? They handed over the steering wheel of monetary policy to Germans. Germans are good at monetary policy. So what did they do? They effectively eliminated inflation risk because Germans were running the show. The problem is they lost the ability to inflate away the value of the debt, the traditional Italian solution to everything. Now, the problem is, so that kind of looks really cool, and if you look at, so what's being graphed here, this is the spread of 10-year bond yields over the German T-bill, over the equivalent to the German Treasury bill rate. And what you see is Greece, look at, it starts, that spread's coming down as the Germans are more and more controlled and people believe the Germans are driving the car, right? That's an enormous benefit to a society to have their debt go down by 250 basis points. But the Greeks are still building up debt. So it's true there's not inflation risk of inflating stuff away, but what's the other thing they can do? They can say, we're not paying. They can just default. In the end, these are monetary tricks, right? You're buying yourself time to get your fiscal house in order. So you can trade inflation risk, but the flip is you're building up sovereign debt default risk. Now, this last, you can see what's happening to the Greek. You see that by the end of the sample, right? What's going on? It's exploding. Well, a couple things happened. The financial crisis happened, so the Greek debt went up. The other thing that happened was they found out that the Greeks were systematically cheating on their data figures. I mean, I'm not making that up. The Greeks were systematically, for example, first they said it was 3%, then they said it was 5%, then they said it was 7.7%. Now it's 12.5%. That's the actual data point. Well, if the Greeks can cheat, why not everybody else? Should you trust the other debt figures? So what you're seeing is a lot of panic, well, I shouldn't say that, a lot of concern in the market, and we can see what's happening to the credit default swap rates. That's basically the price you pay for insuring. If you buy a bond, you can go to Charlie if he's in the private sector, say, Charlie, what are you going to charge me for insurance if the Greeks default? That's an indicator to me, if those rates go up, that Charlie's real concerned about insuring that debt. And in fact, we can back out what the market's assessment is of a default. Now, this is a very volatile market in the last couple of days. So actually, the data looks a little bit better than it is here. So now the probability of a default as assessed by the market is down to 25%. But that's a heck of a number. That's a big number. Now, if these guys blow, right, so suppose that they're not bailed out. There's risk here always. If they're bailed out, that's a heck of a moral hazard problem for the people in Spain, Italy, Portugal, because those are big, Spain's a big country. Italy's a big country. Greece, love them, but they're not a big country. The real issue is what's the incentive set up for the other folks. So then you start talking about inflation risk for the euro. If they do not get bailed out, rates are going to go wild. Because part of the reason rates aren't that high to begin with now is that people think they may be bailed out. Now, what is that going to tell holders of muni bonds in the United States? What is that going to tell holders of California bonds? You can easily imagine contagion from a sovereign debt crisis in Europe, potentially to a sovereign debt crisis here. If nothing else, assessment of risk is going to go way up. And that's going to drive up rates on perceived risky bonds. You'll get a flight to safety. So once again, you can imagine T-bill yields on short-term T-bills getting very, very low. That's a real risk. I'm not saying it's going to happen because it very much depends on how this is played out in between Washington and Frankfurt and private markets. Now, they will take away my professional license if I leave without hectoring you about the debt in the United States. So I'm going to do that very briefly. Whatever crisis we have now about the debt-GDP ratio, it's rounding error. These are the Congressional Budget Office estimates of the out years of what will happen to debt to GDP ratios in this country. They started off at around 45% in 2007. If we do nothing, by 2057, depending on the precise forecast that you look at, we will be roughly 100%, probably much larger. Under another scenario, 150%. Pretty soon you're talking about Argentina territory. That's not a neighborhood you want to live in. I'm not telling you what has to be done to deal with the federal debt, but something has to be done. Or we will have a very severe crisis. Time constraints prevent me from doing that. Let me end by saying, financial markets and the real economy are stabilizing. That's good news. Looking forward, this looks like it's going to be a sluggish, more sluggish than a typical post-war recovery. There's a lot of substantial uncertainty about the nature of the recovery with shoes that can still drop. But in the end, I would argue to you that the really large concerns for perhaps the next alumni talk is uncertainty about the long-term fiscal health of the United States. My own personal assessment is that tax rates will rise. That's about the only conceivable way, and I don't just mean on the rich, I mean on everyone. It seems inconceivable to me that we will be able to pay for these things by tricks. And that's good news or bad news, depending on your political inclination. Thanks.
Okay, we'll see if I need the voice from above to do this. We do, because you closed my talk, Marty. There we are. There we are. All right. Well, thank you very much for this enjoyable evening, and to the Fed for hosting Northwestern here tonight. Part of the theme of my comments this evening will be about the importance of great institutions. So I think it's apropos that we're meeting at the Federal Reserve and that we're gathered here tonight by our affiliation with Northwestern University. The theme of my comments will echo some of the issues that Marty raised. As I'm thinking about the financial crisis and the economy then versus the economy now, the economy then will always resonate with me because I was teaching an introductory finance course at Kellogg, Turbo Finance, in the fall of 2008. And I teach that course on Mondays and Thursdays. Usually you're pretty safe on Mondays because nothing happens over the weekend. But in the fall of 2008, it seemed like everything happened over the weekend. So Lehman not only failed, but disappeared. The Treasury bill rate was negative. That was the rate of return associated with just don't lose my money, please. Okay. The CDS rate, so the rate that investors would pay in order to get insurance on a bond, was more expensive on U.S. government bonds than it was on McDonald's. So I think it came as something of a shock to Hank Paulson to find out that he had less credibility with the markets than Ronald McDonald did in the fall of 2008. It was a difficult time. But since then, we've hopefully rounded from the sense of panic that we had in those few months in late 2008 and early 2009 to a point where, at the very least, we have a sense of sort of uneasy calm in the market. So a way of saying that the panic does seem to be over. But I'd like to talk about how the recovery looks, how robust the recovery seems to be, and then what the issues are going forward, and also to have some clarity about some of the risks that we avoided along the way. So first, in the GDP growth, in the fourth quarter of 2009, this very enthusiastic number of 5.9% came out. And there was the sense that, a sense of hope, a sense of relief that perhaps the Great Recession is over, that we can really move forward.
But you see, of course, looking back to the fourth quarter of 2008 and the first quarter of 2009, that the Great Recession was indeed a Great Recession, that there was a tremendous amount of output lost over that period. And what we're seeing here, again, not to confuse levels and growth rates, is that there's a reversal of the downturn, but not a rebound. So the economy is starting to turn around, but we're not seeing the sort of very strong growth that you would see if you looked at historic U.S. data. So this is the same scatter plot that Marty put up. I put the green line through here, which shows you the historical averages of the response of a recovery to the depth of a recession. So what's on the horizontal axis is the depth of the recession, so the percent decline in GDP from peak to trough. And the vertical axis measures the strength of the recovery, which is the percentage growth in GDP for 1 year after the trough. So typically, when you have a very severe recession, you have a rebound, right? Not just a reversal of the downturn, but a sharp rebound. So in this case, the red dot shows that indeed we had a very severe recession, the peak to trough decline in GDP. If we put the trough in GDP at the second quarter of 2009, we just be bold and forecast when the trough will be dated, it's a little over 3.5% decline in GDP over the course of the recession. If we look at GDP growth since then, since the second quarter of 2009, you have a little under 4%. GDP growth since then. So again, there's a reversal of the decline. So the recovery, so if you just project forward the current recovery for a year, you'll reverse the GDP growth that we lost during the recession, but you don't get a rebound. So you don't get back to the level that you would have had or the trend that you would have had before the recession. So why is that? Okay. Well, this breaks out the GDP growth into its components from 2006 through the fourth quarter of 2009. And you see that in some components, some portions of the economy, there's been growth all along. So the dark green there is net exports. So the fall in the value of the dollar from 2005 to the beginning of the recession stimulated economic growth and makes a positive contribution to GDP in virtually every quarter. But where you see the sharp declines in 2008 and early 2009 is all in the blue and the purple colors, which are all investment categories. So residential investment just collapses, and that's no surprise given the nature of the financial crisis that we faced. But non-residential investment also collapses. So corporate investment in equipment, corporate investment in new technology, corporate investment in software, all of the things that would contribute to future productivity growth are also collapsing along the course of the recession. And then the purple there is the change in private inventories, which during the recession is negative, negative, negative. It's just declining throughout the recession. And then you see in the most recent quarter, the biggest contribution to the recovery, about 2/3 of the increase in GDP growth is coming from this reversal of the decline in private inventory. So it's not that we're producing output and building up inventories again, it's just that we've stopped shedding inventories so quickly. So that's a major contribution to that big number in the fourth quarter. In the third quarter, the bright orange that you see there is durable goods. And durable goods in the US means cars. So there's one thing that dominates the durable goods data. So that third quarter number is cash for clunkers. So that's it. The other thing that's going on in these data is a little bit of a recovery in residential investment because of the tax credit for first-time home buyers. So as you look at this part of the recovery, you can spot each individual contribution to positive GDP growth, and each individual contribution has a one-off feel to it. Like the recovery in inventories, the recovery in inventories, the cash for clunkers, the residential investment. It doesn't have that robust feel that Charlie was looking for that's going to signal a return to normalcy or return to long-run growth in either consumption or in investment. So why is that? Well, this is not a typical U.S. crisis. So you go back to the past recessions for the U.S., none of these was associated with a financial crisis of the sort we've just experienced. You have to go outside U.S. data to have a serious look at financial crises. So the IMF has done some nice work on this. And in the upper panel of this graph, you see an average of past banking crises across different countries. And what they are doing here is rolling forward the GDP after the crisis. And the gap between the blue line, which is the GDP forecast, and the black line is the difference between GDP and trend. So what the trend that the economy was on before the crisis, and the blue line is the GDP on average that they achieved after the crisis. And the shocking thing from this graph is that the crisis countries are 10% below trend 7 years after the crisis is finished. So these are pretty sobering numbers. I hate to give you this at the end of a cocktail party, right? It's quite shocking. And this is why all of those forecasts about the recovery from the crisis are so tepid, that we're not, use words like sluggish and slow and wait for robustness, because everything in our history, everything in our database about financial crises suggests that it's a long, slow road back from a financial crisis. And the data that we got just last week that showed credit growth in the U.S. banking system over the past year was not very comforting, because credit in 2009 for the U.S. banking system showed the slowest growth rate that it had experienced since the Great Depression. So these are not the sort of numbers that are going to provide financing for a robust economic recovery. The data that, Marty, I'm going to put a different light on these data. This is from Reinhart and Rogoff's study of past financial crises. And the point that jumps out from here that I share with Marty is that when you look at financial crises, they last a long time. So what the right-hand part of this panel shows is the average duration of a downturn associated with a financial crisis. And on average, it's about 2 years. And the left side shows how much output is lost over the crisis. And on average, it's almost 10%. Okay? But I want to draw your attention also to the countries that are here, because here you can start to draw some distinctions between this experience that's informing our reaction to a financial crisis and what the U.S. has just been experiencing. So Thailand, for example, over the course of their crisis, they lost about, even in a single year, they had a 10% decline in GDP. Korea had a very similar experience, but let me show you what happened to their exchange rate during the crisis. So they had a very severe crisis in the capital markets, in addition to the banking crisis inside the country. So in 1997, actually the horizontal axis is 5 years off here. In 1997, the exchange rates of both Thailand and Korea and other countries that were involved in the Asian financial crisis, their exchange rates fell by about 50%. So it was a shocking decline in the value of their currency. Okay? That's quite different than the U.S. experience over the financial crisis. So here there's actually a little bit of good news. The financial crisis in the U.S., you see, after 2008, in this ominous fall of 2008, the value of the dollar actually went up. Because there was not capital flight out of the U.S. There was actually flows of capital into the U.S. Okay? Because the point with the value of your currency is not to have the perfect economy. It's not to have the perfect capital markets. It's to have a stronger capital market than the rest of the world. Okay? So the crisis that embroiled the U.S. capital markets and the global capital markets was not just a U.S. crisis. This was a global crisis. And every country's experience has been slightly different. So the flows of capital have actually been pretty interesting. So this is from balance of payments data. And the green bars here show official holdings. These are inflows, not the levels, but the inflows into official holdings of U.S. government securities. So throughout the crisis, international capital was flowing into the U.S. and investing largely in U.S. Treasury bonds. This is why the yield went negative, right? So there was a lot of interest in investing in a safe security, and it turned out that even in the midst of a financial crisis, U.S. Treasury bonds were the safe, it's relative safe, right? The relatively safe security in the global economy. You also see this in the red bar. So not only did official holdings flow into the U.S., but private holdings also flowed into U.S. Treasuries and basically invested in U.S. government debt. Okay? So the part that's below the horizontal axis are private capital flowing out of non-government debt. And then above the axis, you see where it's going. It's flowing on net into U.S. government treasuries. Okay? Well, that gives a slightly different picture of what's happening in capital markets and in debt markets in the U.S. in the crisis. Because in Thailand or in Korea, for example, when the value of the exchange rate fell by 50% during the crisis, there was massive capital outflows. And if you're trying to finance a government budget deficit during that period, you have a real problem. This is why the IMF steps in and why you have an international bailout of some form. But in the U.S., private markets stepped in to buy U.S. government debt. Okay? Why is that important? Okay? Well, it really changes the nature of the crisis. You still have a banking and financial collapse. You still have a very severe recession, but you have a currency appreciation and capital inflows. Okay? And that changes the nature of the deleveraging in the economy. Because there's lots of talk about the need for the economy to delever. So you see this in the housing market. The mortgage holdings are going down, the value of mortgages are going down, and the counterpoint to that is in the household sector, you see the savings rate going up. So there's less borrowing and more savings. Banks are delevering, the financial sector in general is delevering. So where is all that capital inflow going? Because it's clearly not going into these delevering sectors. It's going into the government sector. So there's more leverage in the government sector that's financed by these capital inflows. And what that's done is finance the increase in the government budget deficit. Okay? And as much as we worry about the long-run implications of the government budget deficit, it's a tremendous asset, a tremendous benefit to the U.S. government and the U.S. taxpayer that there is capital flowing in that's willing to buy that debt. Okay? So here's the deficit number And you see historically that outlays, which is the dark blue line, have exceeded revenues for a long time in the U.S. economy. We've built up a lot of debt. There was this brief period around 2000 where the light blue line exceeds the dark blue line. So we ran a brief budget surplus there, this briefly nirvana, blissful period where we wondered what we were going to do with all the money now that we were running the budget surplus. But we needn't have worried. That period passed, and the budget deficit came back, and you see how it explodes in 2009, 2010. And it's both because the expenditures go up. A large part of that is paying for unemployment benefits, the stimulus package, the expenditures on the financial bailout, and those disappear over time as the economy is forecast to recover. But the gap between those expenditures and the tax revenue, which is shown in the light blue line, persists indefinitely. Okay? And that's where Marty's graph showed this massive accumulation of debt over time if this continues. So it's clear that the budget deficit is simply not sustainable. Okay? We have a gap between outlays and revenues that doesn't go away, even as the economy is forecasted to continue to grow. Okay? The other place where this leverage shows up, and I'm sorry, Charlie, but I have to put this up. This is a summary view of the Fed's balance sheet. And which has changed dramatically over time. If you go back to pre-2008, there was the Fed the boring Fed balance sheet that we all knew and loved, which was mostly Treasury bills. And over time, what's happened, of course, is that the Fed balance sheet has expanded dramatically, at one point by a factor of 3, and that the composition has changed as well. And this is the other place that a dramatic amount of leverage shows up, not in the private sector, but in the public sector. So this beige, putty-colored area at the top is Fed holdings of agency debt or mortgage-backed securities. And there's about $1 trillion worth of mortgage-backed securities being held on the Fed balance sheet. And this is another place where there's been deleveraging in the private sector. So there's not private holdings of those mortgages, but then the leverage shows up in the public sector. So this is the change in composition in the U.S. economy that has allowed the economy as a whole to keep a large amount of leverage, okay, even while there's dramatic deleveraging in the private sector. What's happened is that leverage has shifted over to the public sector in the form of Treasury debt and partially also on the Fed balance sheet. So what does a financial crisis U.S. style look like as it winds down? Well, the proximate cause of the financial crisis was much more narrowly in mortgage markets, and there's clear attention to needed reforms in financial markets, though those are also unresolved. The severe recession is moderating, but what we have is a legacy of public sector debt. And it takes on various forms, but that public sector debt, even as the economy slowly recovers, will be the long-lasting legacy of the recession, and in some ways will be the test of how the U.S. economy responds to that. So a final lesson is in some ways as much about political economy as it is about economics. As severe as this recession was, the U.S. has actually benefited from the flight to relative safety in the global economy. This has been a dividend of strong institutions, or at least the perception of strong institutions. So the surprisingly valuable asset to the U.S. economy in this recession has been strong political, strong economic and ongoing credibility of the institutions of the American economy. So the preservation and the enrichment of those institutions really bears attention at this point in time, because this recession could have played out even worse, could have played out much more badly if the institutions had not had the strength that they do. Okay? All right. Some Q&A. All right. Thank you.
They don't call us the Sunshine Kids for nothing.
Yeah. They do call me Professor Sunshine, actually. Yeah.
Are there any questions? Folks?
There's a question here, and I think they have a mic to give you to ask the questions.
Thank you. Neither one of you mentioned the possibility of a double dip, and maybe you could explain why there won't be one.
You know, I think the most of the professional forecasts, I mean, what are the risks now, right? Well, it's not what you expect. It's, you know, things that are priced into the market are easy to deal with. It's the things that you don't expect that are going to cause that double dip. So I think one of the big issues is, are there big surprises to come from commercial real estate? If there's a big surprise there, now remember, the commercial real estate market is a much smaller market than the residential housing market, so it'd have to be a really big surprise. I think, you know, there's a potential downside risk from the muni market. You know, if something bad happens in Europe with defaults, that could easily push us into another substantial, you know, a double dip recession. But I think the professional forecasters are saying, you know, you can't predict the unpredictable. That aside, it looks like a slow, sluggish recovery.
Yes.
Michael?
Just like to invite you to comment on the root cause of the Great Recession.
Well, there's a couple of ways to go with this. I mean, it clearly started narrowly in real estate markets, and in particular in subprime. But if it had only been subprime, right, then basically the first TARP would have been big enough to pay off the whole thing, right? So there's two parts to it. One is what happened in subprime, which was sort of the spark. But then the larger question is how that propagated, how the subprime crisis propagated through the rest of the economy. And there people have worried a lot about the particular instruments, structured credit in particular, in financial markets. And the lack, and this is where I mentioned that there's financial reforms that are, you know, yet to be done and haven't gathered a lot of momentum yet about what exactly to do. But the issues there are clearly transparency, no pun intended, because these securities tend to be pretty opaque. And it's not clear, you know, you have a CDO that's broken up into, you know, 30 tranches. You know, do you really need 30 tranches to address all the different risk tolerances of investors? Perhaps a simpler structure would suffice. So transparency, simplicity, you know, those were all issues in propagating this spark. And you know, there's more, because it's not only the CDOs that propagated, there's also, you know, how do banks know what their counterparties are holding? That's another issue with transparency that propagated that initial spark. So there's a range of issues around financial market structure and financial security structure that propagated what happened in subprime. So some people focus on subprime and the need for reforms in retail banking and retail lending, but you can't that alone wouldn't have sparked a crisis as big as this.
Let me just add, I completely agree with everything Jan said. The other thing to add is, as you look across international evidence and some of the countries that Jan put up, many of these financial crises are associated with housing bubbles, and I will use that word. Housing bubbles, when they get intertwined, as they almost inevitably do with the financial system, highly leveraged financial system, end badly. So from my own point of view, I think we have to ask ourselves, what is it about our markets and or political process that allowed a housing bubble to get off the ground? And I really do think that unless we can prevent that, financial markets are awfully clever and they'll figure out some way to finance the next housing bubble that comes along.
Question over here.
Yeah, some commentators have talked about the relationship between the CDS market and the potential sovereign debt crisis. Some people seem to think that the CDS market is driving potential liquidity in the underlying cash bonds, where other people think that it's actually sort of driving up the risk premium and making people more concerned about, you know, the underlying risk of default. Do you guys have a point of view as to whether the CDS market in sovereign debt is helping or hurting the situation in Europe?
From my own point of view, I don't see that as a particularly exotic financial instrument. The problem is that a lot of these countries have enormous debt to GDP ratios. They're getting increasingly less competitive. I didn't have time to put up, there are many benefits to a common currency, but there are also many minuses. And so you have extremely uneven growth in different parts of Europe. Labor costs in Greece, if you look at unit labor costs, have been gone through the roof. That, again, the traditional way of alleviating some of that growth, those high wages, were these devaluations. That's no longer possible. And so you see this large growth in all the so-called pig countries in their unit labor costs relative to Germany. And what's less known, perhaps, is the Eurozone as a whole does not have a particular current account problem, a trade deficit problem, but all of the periphery countries, Greece, Italy, they're running big trade deficits vis-a-vis Germany. So the German labor costs are very low, they're very efficient, and there doesn't seem to be an easy way, because of political reasons and other reasons, to get those unit labor costs down in the periphery countries. And then if you have one common currency, the traditional methods that we have are not available to those countries. So I don't think the CDS is causing the problem. It reflects the problem.
Yeah, I'd agree. The CDS is a valuation, a manifestation of the sovereign debt issues and the adjustment issues that Marty is raising. One issue that comes up all the time is, how is Greece any different than California, right? So, you know, they're both Mediterranean, warm, and, you know, and they have huge amounts of debt that they don't seem to be able to deal with. But the big difference is, of course, that people are more than willing to move in and out of California. There's huge labor mobility there. And Greece, you know, several of my colleagues are Greek, and the tragedy of their lives is that they left Greece. So the people who live in Greece, you know, there's language barriers between countries, there's administrative barriers between countries, there's much less labor mobility. So this other way of adjusting, you know, if you can't devalue, then maybe the factors of production can move, but they don't seem very interested in doing that.
And in fact, one of the big benefits of the euro, let me just add, that has actually exacerbated this labor mobility problem, is there is capital mobility in Europe. So now what's happening is capital is fleeing to the countries with the low unit cost, labor cost, namely Germany, and leaving Greece. So that just makes it, this partial reform, if you like, has actually exacerbated the difficulties of being on one common currency.
Okay, two quick questions. One on the European issue, don't you have to take into consideration the size of the countries? God bless Ireland, but it's only the size of Indiana. And to put it up there is an equivalent of any other country, I think has to be taken into consideration. And more importantly, the criticism of both the end of the Bush administration and the current Obama administration is the bailout in general. And someone like a Ron Paul says the market should have just handled it. But I never hear them talk about what the world would have looked like had we not had a bailout. and what a Ron Paul world would have looked like, and can you extrapolate on that?
I can only give you my own personal opinion about this, that if we had not had a bailout, the unemployment rate would have been far, far greater. We would have been in very, very bad shape. So, you know, I like this analogy that I think President Obama had, which is your neighbor's house is on fire. You don't worry about the regulations right there. You put out the darn fire. And once the fire is out, then we can talk about regulations. And I think we should talk about regulations. But you put out the fire. I don't think any responsible public official would have said, let it fly. I think that's sanguine. I think it's a shallow analysis, and it's a cheap debating point. Yeah. So I guess my position's clear.
Yeah, and a last comment on the scale issue. So we tend to look at, you know, deficit or debt as a share of GDP. And so there you look at the U.S. deficit is about 10% of GDP, and Greece's is 13% of GDP. And so you have this sense that, you know, Greece is really in trouble. But U.S. GDP is enormous by any standard. And so you take 10% of U.S. GDP as your deficit, that's $1.4 trillion in 1 year. So that's larger than the GDP of most of the countries we're talking about. So if we're going to worry about scale, we should start at home.
If hindsight is 20/20, so if you have to evaluate the response of the Federal Reserve to this crisis, what would be your conclusions on what went well, what did not go well, what would you do differently next time?
That's a lot of questions.
That's a lot of questions. Charlie is grimacing.
Let me say this. Okay, so Charlie's here, and that's good. I think if you look before the crisis, there was a political failure, a government failure to deal with a nascent housing bubble. I think there was a widespread failure to do effective regulation that I think most people now think, you know, we let get out of hand. Some of the comments that Jan was talking about, you know, for the SIV, various transparency issues, we perhaps could have known that ex ante and done a better job.
Okay. And there's some things that at this point seem so obvious, like having a way of resolving financial firms when they fail, right? There's no legal framework for doing that. And it's not clear what it should be, and there's going to be a lot of debate and a lot of discussion about that, but not having one seems like an obvious problem. And this was identified before. It's not as if this was a big shock to anybody, but it takes will to resolve the debate that's going to come up when you try to introduce a new policy. And we just didn't have that will. And you know, the same is true of other regulatory issues. So I think a benefit of the crisis is hopefully we have some will now. One last question, we're being told.
This crisis that we've gone through by all standards has been pretty amazing globally. The typical, the U.S. has been the 800-pound gorilla to lead us, and now perhaps we've shrunk to a chimpanzee. And I was wondering, can the Asian consumer really be thought to lead us out to a worldwide growth? Because there's talk of the middle class that's coming, the farm coming to city. Are they really going to be the engines for growth for the entire world?
No. The numbers just don't add up. The numbers just don't add up right. But once we're on the topic of Asia, let me just, unless you...
Go ahead.
If we're going to talk about Asia, there's a lot of talk about China's currency being overvalued, which I think it is. But if you ask... undervalued. But if you ask, could China change our trade problem with them, our trade deficit, just by getting their currency right? The answer is absolutely not. The United States is running enormous deficits. That has to basically translate into current account deficits are intimately connected with government deficits. To change the trade deficit problem, we need to get our house in order in the short run and in the long run. The exchange rate stuff vis-a-vis China is rounding error.
Right. So most estimates of a revaluation of China's currency, so say you revalued that by 20%, 30%. You run that through the relative cost of production, right, compared to the U.S., it just doesn't move the cost of goods enough to close the trade gap. It's just not quantitatively big enough. So it raises lots of red flags and it gets lots of rhetorical flourishes because it's a big target, but quantitatively in terms of the trade deficit, it doesn't get you there. I think we're...
Yeah, please join me in thanking our fascinating panel. Pleasant evening.